Hey everyone, welcome back to Yuri's Box. In this video I'll be talking about PPI, surveys, and I'll be tying it all back together to TLT. If you like this kind of content, consider leaving a like and subscribing to the channel. And as usual, nothing in this video is financial advice. So today was another data dump day. We had basically everything come out around 2:30 p.m. if you're in Europe, 8:30 a.m. if in the States. The best place to start is PPI, and also retail sales. The control group for retail sales, which is what goes into GDP, came in a bit soft. PPI as well came in, well, basically was a miss across the board. This is CPI. And you can go through the single items right here. But, there is a continuation of a theme, if you will. If you look, for example, services continues to kind of move down. It's similar to what we saw yesterday. For example, I pointed out airline fares, other things. I don't remember what I spoke about, but regardless, you get a sense that you have a situation where, yes, you might have some goods inflation, but it's getting offset by something else. And this goes back to the theme of really the consumer not being in a position, and therefore businesses not being in a position to really have much flexibility in the face of rising prices, that is. Again, the example I can give you, and I've been giving you for quite a bit, is the example of a car. You have to buy a car. Imagine you have $10,000 at the end of the month, $20,000, whatever. Let's say 10 for this example, just to switch things up a little bit. 10,000 down payment for a car is 5,000 before tariffs. You have 5,000 left to enjoy. Vacations, hotels, booze, alcohol, whatever. Okay. But then tariffs come along, they ruin the party, and instead of having to put 5,000 as a down payment, you have to put 7,500 as a down payment. All of a sudden, it's no longer 5K that you have left over, it's $2,500, right? And it's less money they can spend on everything else. And that is really the problem that I've been highlighting. And that is where I think we are headed, honestly, in a situation where, yes, you might have inflation in some parts, but because wages aren't in a position to shoot higher, as we saw, for example, during 2022, 2021 really, and 2022, again, it doesn't give a lot of leeway to the consumer to chase those higher prices. You're going to have to offset the increase over here, over there. All right. So that's kind of I guess you could kind of start seeing it in the data right now. Again, you can see some inflationary impulses, perhaps by tariffs in some areas, and some deflationary impulses in other areas. There are people that are way more savvy than I am and have spent way more years than I have on these subjects on Twitter. Do follow them in the on Twitter. I have their profiles linked in my bio below, so do check them out. Anna Wong had a nice thread just earlier today explaining this in quite detail. So I just suggest you check them out. So, again, PPI was a miss. Initial jobless claims, that's another interesting one. Because, again, if you've been following this channel, I'm not too enthusiastic about initial jobless claims. For the simple reason that by the time initial jobless claims pop, ruin the pooper, all right? That's it. So, again, if you're waiting for initial jobless claims to tell you something, you're basically asking to be late. On the other side, when I started making videos, it was right around here, more or less. And my speculation was that we would see exactly what we saw last year, all right? A bottom around January, and then a slow grind higher as we move towards the summer. And we could argue that we're seeing exactly that. What is interesting to me is that we are sticking around this 229 level, and if you continue to see initial jobless claims stick around this area, anything above 220, again, me personally, the way I treat initial jobless claims, anything below 215, you can expect the unemployment rate to come in a little bit cooler. Anything above 220, you can expect the unemployment rate to move higher. So if you continue to see, initial jobless claims stick around, let's say over 225, 220, 225, you could start to paint a certain picture of, what the next unemployment rate could look like. So again, initial jobless claims at 229, continuing jobless claims, got a little bit carried away there with the O's, the acronym. Again, nothing too dramatic, but we are still sticking around this range right here, potentially, leading up to some kind of a breakout. Now, what do continuing jobless claims really tell you? The way I treat it, let's see if I can get it right. Continuing jobless claims, there I go, is that basically what this tells you is that it is getting harder and harder for people to find a job once they lose it. All right, you're spending more time unemployed, therefore it's harder to find a job. And another way of looking at this is, let me if I can remember it. Yes, this one here. Basically, this is another way of looking at it. You have number of unemployed for basically 6 months, basically. I think I'm getting that right, 27 weeks. Regardless, it's on the rise, right? And that is another way of looking at the state of the labor market, meaning that, again, if you lose a job, I mean, it's not Armageddon. It's not, this, all right? But it is harder than it was back in 2022, all right? So keep that in mind as well. And again, this goes back to the idea that we're not likely to see a spike. I mean, if we do see a spike, it'll mean that it's, some kind of a shock occurred, and we have to deal with it. But until if we get to that, until we get to that point, I'm expecting this to be a process. Something that week after week we continue to see little by little erosion in the labor market, until eventually, if left unchecked, it could lead to a more severe outcome. Next, we got, Philly Fed and Empire surveys for the manufacturing sector. I'll start off with Empire. Now, this is quite a buggy document, PDF. I wanted to highlight certain things, but it just ended up, Picassoing all over. So it is what it is. Regardless, Empire was a little bit more, had a dimmer outlook. It was a bit more negative and pessimistic. Philly Fed for this month was a little bit more upbeat. Again, we can look at it at the Empire first. The headline number was a miss. Where did I see Empire? Right here. Consensus was it was basically in line. I mean, it was a slight beat, but regardless, employment declined, as did the average work week. Input price increases continue to pick up, while selling price increases slowed. Now, again, this is continuing to play into the theme that I think is going to be the main theme for 2025. I continue to fade the notion that it's going to be extremely easy for businesses to raise their prices and just pass them on to the consumer. You might see that in certain areas, but I don't think it'll be as straightforward as perhaps the consensus view would have us believe, honestly, because of everything we've been over. The consumer isn't in a position where it can just stomach continued increases in prices. And again, look at the quits rate as a great example of this. The quits rate is going high. That means people are, switching jobs. That means that they have the leverage in the workforce. That means that they can, go to their employer and bargain for a higher wage. But that's not what they're doing anymore. All right, that we're at the other end of the spectrum. All right, granted, quits rate has been going up a little bit, but regardless, we're still far away from the highs, and that is really the signal I would take away from it. So again, input prices going up, selling prices, not keeping quite up, and that basically translates to a squeezing of margins. And again, if your profit margins get squeezed, the only way you have of defending that margin is to reduce the workforce. All right, but that is still a ways out, in my opinion. I wouldn't be banking on that for May. I think that July and August are definitely some interesting months. I've been pointing towards the summer ever since I started making videos. I continue to believe that if we are to see some kind of weakness similar to what we saw last year, it will come in the summer. What could make it worse is the lack of positive catalysts from September to December, apart from the Christmas holidays. All right, going back to the Empire survey, firms remain pessimistic about the outlook, with the Future General Business Conditions Index holding slightly below zero. The General Business Conditions Index remained similar to what it was last month. Again, the index of for number of employees came at minus 5.1. This is kind of the part where you can see kind of the pessimism in the survey. Number of employees coming down, work week coming down. Input prices going up, again, as you can see right here, again, prices paid going up, but the selling prices, not great. So firms continue to expect conditions to worsen in the months ahead. Again, this isn't anything new if you've been watching the channel. And again, you can just scroll here through all of the indexes for the Empire Manufacturing Survey. Moving on quickly on to the Philly Fed Survey. This was kind of the more upbeat survey. So again, you can kind of see the bumps right here. And you'll see plenty of examples of this throughout the survey. Manufacturing activity remained weak, according to firms, but firms continue to expect growth over the next 6 months, and expectations were more widespread. I could make an argument that this is kind of similar to what we saw, if I'm not mistaken, between March and February, where February was quite negative, but March was better than February, so we saw kind of this optimism pick up. All right, and I can kind of make the argument that that is what we're seeing right now, given the fact that we had that big walk back on China. We went from 150 or whatever, 100 bajillion to 30%. And again, I continue to make the argument that yes, it's good news because we went from an embargo to something that is manageable, but still 30% is nothing to scoff at. And again, it's not good news. If someone told us we were having 30% tariffs on China, okay, it's not 150, but it's still a lot, okay? But because you go from 150 to 30, at the very least, that makes things not look, as a complete cataclysm, all right? Something apocalyptic. So I could make that argument, but let's take things at face value. Most firms continue to report no change in employment levels, while the share of firms reporting increases exceeded the share reporting decreases. So most of all, most firms didn't really see much of an increase in employment levels, while at the margin you did kind of see at least some increase in the labor forces. Again, you continue to see increases in prices, continue to pressure margins. Moving on, most future indicators rise sharply. On balance, the firms indicated an increase in employment, and the price indexes rose further above their long-run averages. The survey's broad indicators for future activity suggest more widespread expectations for growth over the next 6 months. Again, if you go from an embargo, all right, with a country like China to something that is manageable, of course, yes, that will increase, the outlook, or rather, will make the outlook look less, dark. Yes. So it's kind of like a balancing act between what we're seeing in the Philly Fed for this month and the Empire surveys. One's a little bit dimmer, one's a little bit more upbeat. Probably the truth is in between. I would still wait for the beige book. I think that the beige book will continue to build on this. If I'm not mistaken, we should be getting it next week or the week after. Maybe actually, now that I think about it should be in the first week of June, something like that. But regardless, I would continue to pay attention to the beige book. So that's really the surveys. One's a little bit more pessimistic, one's a little bit more upbeat. We'll see how the rest come out. Next week is PMI week, so all eyes on that. And as far as the rest is concerned, that's pretty much it. You did have some housing data, the housing market index, NAHB, NAHB, and there I got it right, was probably one of the lowest that we got from ever since 2022. But again, that is for the housing experts. I'm definitely not a housing expert. One other thing I wanted to point out. I actually missed this because again, the summer is my most the busiest time of the year. So again, I'll be making these videos, and usually things will slip through the cracks. But we did get some new data, some new revisions on the job gains, actually, and we got data for the third quarter of 2024, and it wasn't that great. So accounting for all the revisions, the third quarter started seeing job losses of last year. All right, then employment change after doing all the homework, all the revisions. Job losses likely started last year in Q3. We actually stagnated in Q4, but we will be getting actually more data on that in when is this? In June, actually next month. We will be getting more revisions actually, and again, at the very least, what these initial revisions, really what the Philly Fed here again is pointing at towards is potentially, again, slower growth, further revisions to the data coming back, looking back on last year. So, and again, why do I bring this up? If you remember, there I go. We already had some downward revisions for this year. All right, we started off with 125, 117,000. This was about 150. 185,000 for March. This was about 220. So we're already around, give or take, if I'm not mistaken, between 70 and 100K, lower. But the big revisions come with the QCEW, the Quarterly Census of Employment and Wages survey. And what they basically do is the non-farm payroll survey on steroids, all right? It's just a huge overhaul, and they just go over the data. And, you get data that is probably a lot more accurate than what the initial number is, would be telling you on the initial release. So why am I pointing this out? Because again, while it is important, and again, I'm not totally discounting the data that we get each month, at the end of the day, did anyone know that we saw job losses in Q3? No. All right. But here we are, a year later practically, and lo and behold, we started seeing job losses last year. All right. And that is usually how these things go. Even in 2008, again, I can't help myself but talk about 2008. I will. If you've been following this channel for this long, you'll know what you got yourself into. Just looking at the 30-year bond, as just for time reference here, they actually backdated the recession back here. All right, in December of 2007, and that was kind of a shocker to everyone. That, wow, the recession started in 2007. We didn't know. Yeah, that's the thing. You never know when you're in recession. By the time you know you're in recession, again, the example I can give you is, initial jobless claims. If you're waiting to know that you're in a recession, well, you're going to be late. If you're waiting for initial jobless claims to pick up, it's like waiting to smell like rotten eggs before you have a shower. You're going to be late, all right? All right, and by the time it happens, it's already finished. So, and again, why do I bring this up? Because again, trying to time things, trying to say, I'll play the casino and then, I'll get out before everybody else. It's a lot more complicated than that. So, but that's just my, my nature of being a conservative investor. So, that really brings us back to TLT. And before I move really on to TLT, I just want to take a bird's eye view of the markets in general, because what do we have? All right, we have stocks moving up. All right, we've had a nice move up, especially in the last this week right here. We'll see how we end the week tomorrow. We have bond yields up, basically. All right. Bond yields have gone back to their January 2025 highs, as well as the spikes we saw in mid-April. And to finish everything off, we have the dollar well below its January 2025 high. Now, just leaving stocks aside, because again, as I always say, stocks behave one or two ways. They either have to price in a recession because the end of the world is at hand, and so we have to go down 50%, or we're not in a recession and we can go up. That's basically what stocks do. All right. So leaving stocks aside for a second, what the dollar and bonds are telling me, at least, if you had to point a gun to my head, this is where you kind of see the stagflationary trade, I think, in as of Thursday, May 15th. Lower dollar, probably pricing in lower US growth, but higher yields, pricing in potentially that the inflationary aspect of it all. And that leaves me to the bond market. And I'll say something that I made a video about this. It was actually one of my first videos where I basically kind of dunked on the bond market. But I'll say it again. And I said it before and I'll say it again. we run the risk of treating the bond market as, kind of this Wizard of Oz, the all-knowing, all-powerful bond market that tells us the truth. If you want to know the truth, if you want to know how things are holding up, if you want to know the truth of where we're headed, look at the bond market. And don't look at the stock market, because the stock market is just a bunch of chimps in a zoo. And the bond market is where you want to get your info from. And what I've basically said in the past, and I'll say it again, is that if the stock market is a bunch of chimps in a zoo, the bond market is a bunch of chimps in a zoo wearing a tuxedo, smoking a cigar, probably having, maybe a British accent to sound smart. But at the end of the day, they're just chimps in a zoo, just like the stock market chimps, all right? I really don't buy into this, this entire reverence we have towards the bond market, because the bond market doesn't have to deal with earnings, it deals with fundamentals. Yeah, okay, but every move that the bond market has made in this cycle has been self-defeating, all right? Every move has been wrong, except really for this first move right here, all right? That I can give you, all right? That I can give the bond market. This move right here, to its peak in we're looking at the 30-year bond right now, in October of 2022, I can get on board with this. But the track record after that is atrocious. Starting with the most atrocious of them all, the rally that we saw in bonds from October of 2022 till the summer of 2023. And why did we have, bonds really perform nicely at this point? Well, because we were saying, the bond market was saying, yeah, central banks have hiked rates, but there's going to be a recession because of it all. And so we don't buy the fact that you're going to keep rates higher, because you're going to have to pull them down all over again, because you've ruined everything. All right, so we have a nice rally. It's about 20% rally, if I'm not mistaken. 23. There you go. But lo and behold, no recession. So we have to go back up. All right, and actually we're still battling with inflation. Right here we have the all-knowing Jerome Powell say, yeah, you know what? If inflation comes down next year, we'll cut rates. But great. Now then, at this peak right here, we also had, Janet Yellen announcing that she was going to issue, shorter duration bonds, just to keep things simple. Bonds rally, all right, because yay, hooray, we're going to see lower yields because inflation is going to be well behaved. All right, inflation was not well behaved, all right, to say the least. It was not well behaved, and so we have to go back up. But by the time we're back up here, inflation was well behaved. Let me see if I have it right here. Yeah, you can kind of get it. You can get the picture right here. By the time bond yields went up, this was exactly when inflation started to roll over again. Then we have the growth scare, and we're going to have a recession. It's going to be the end of the world. And of course, we're going to have to, because of a recession, we're going to have lower inflation. Hooray. But from that point on, inflation picks back up, and, the rest is history. So, again, yes, the bond market is very important. Yes, it tells us a lot about, the state of an economy. You can also look at, the China, Switzerland a little bit, not Far East enough. Again, if you look at Chinese bonds, what are Chinese bonds telling you? Does this paint a picture of an economy that is booming? No. Why? Because the long end of the curve is it prices in growth and inflation expectations, mostly. At least that's what I think. And if rates are low, well, what does that tell you about the economy? All right. So, yes, the bond market is very important. Yes, it is consequential, to everything else. Absolutely. But just because the bond market is saying something doesn't make it true. And I've said it before. I said it when, rates were going down right here. And I'll say it now that bonds are on the upside, on the uptrend right now. Just because the bond market is saying something doesn't mean that, it's necessarily true, all right? So now that I've gotten the rant out of the way, I do believe that this is kind of a stagflationary trade that is going on right now. I do believe that bonds are really putting more weight on the inflationary side of the story. I do believe that if we hadn't had PPI come in, with a big miss, really across the board, let's just say it came in just slightly below consensus, all right? Let's say that PPI month over month came in at, again, 0 or 0.1, something like that. I do believe that we would not have seen this kind of a rally in TLT and, lower yields. Because I do believe that, as most of this cycle has been, the bias for rates has been to go higher. All right. And again, I think that as of, really last year, that's when I've, started to shift definitely more bearish on the growth outlook, is that I think that this is probably old news. I still believe that this is a form of inflation PTSD. And that, we should be worrying about other things like growth. Now, as far as the charts are concerned, we're hanging on for dear life right here. Okay, we're hanging on to try and not break this parallel channel that we have. We first established it in October of 2023, January of 2025. We kind of pierced it, we backtested the trend line right here in April, and now we wicked below the parallel channel. Again, it's quite fitting as well on the upper bounds as well. And again, why is this parallel channel important? Because if you've been following this channel, you'll know that I've pointed this out many times. TLT likes to put in double bottoms. Right? You can see it here, you can see it here, you can see it here. Here, and here again. All right, this is 13, 14. But overall, it's usually two types of double bottoms. It's either a sweep of the previous low, all right, so you have a slightly lower low compared to the first one, or it's either a higher low compared to the first one. All right. Now, if we hold, and that is big if at this point, if we hold this parallel channel, you could argue that we're in some sort of, 2010 scenario, 2010, 2011 scenario, where we put in a first low and a higher low, all right? If, on the other hand, we were to break that channel, we could be looking at something a little bit more similar to, basically the 06-08 cycle, where we put on a double bottom, we swept the previous low, and that would put us between, $81.50 and $82, or $80 and $82 at this point, given, the magnitude of the moves in TLT. And then eventually might be going up on the uptrend. That is if we're living through something that is similar to the pre-2008 world, which is what I think, but, we'll see. we'll just see about that. As far as the move today is concerned, most of this was due, in my opinion, to the PPI data coming in quite cool overall. I would expect PCE to come in cool because of what we saw today. I didn't really pay attention to the components, but I would imagine that such a cool read would be constructive for PCE. And I think that is actually what also helped TLT have its nice move up today. So again, PPI combined with CPI yesterday, both very constructive reports for inflation. And so finally, bonds catch a bid in the face of good inflation news. But again, it is hard for me to get very excited at this point. You'll forgive me for the lack of enthusiasm when we're, fighting not to, break this channel right here. Now, could we see a secondary, back test of this trend line right here, which could put us around that $82 mark, whatever, 81.50, something like that. And again, the reason why I was expecting a potential retest right here of this trend line right here is because it is exactly what we saw last year. All right, we had a downward trend, we broke out, we back tested it once, we went up, we stayed up, and then we, we back tested it again. We break out, we stay up, and then we go down, we test it. Then we go back up a little bit, and, potentially, if you stretch this out a little bit more, we could get some confluence right here at the $82 mark. Does it have to happen? No. But again, if you've been following this channel, you'll know that this scenario right here was I've never really taken it off the chart and off the board here, because as long as we're up here, in between 85, the 80s and the 90s, and we're not above basically the $95 mark or the $100 mark, you should leave some room for that scenario to play out. Now, if we were to see TLT go back to $81, $82, something like that, that would actually put the 30-year yield at this beautifully drawn circle, this majestic circle right here of about 5.2, 5.4. That would basically be the equivalent on the TLT chart. And this leads me back to 2008, 2006, 2008, because now you'll know this. He'll know this chart off by heart. But again, this is quite similar in my opinion to what we saw back then. First move up, then down, a messy move up, sideways action, and then first stop, W pattern, sweep of the previous high. What do we have this time around? Move up, move down, messy move up, all right? Then we have sideways action, sideways chop for a bit. First stop, W pattern. And my speculation, especially during here, right in this time frame right here, from January till really the end of March, was that we were exactly following, well, not quite exactly, but we were following that that price action quite closely, and that potentially we were in the downtrend. All right, we were potentially right here. That I still remember drawing this circle right here. And while I was drawing that circle, I remember pointing out the fact that I was expecting some deviations. All right, some kind of deviation compared to that cycle right there, because no cycle is the same, and we could easily see some kind of difference, something different play out potentially. Now, we either follow two kind of blueprints, and again, we're definitely going to follow the third one that I haven't accounted for. That is usually how things go. But I'll give you, the two things that I have in my mind right now. We're either still in this phase right here, and we're still going to put in a sweep of the previous low, and so all of this is just one entire move. Okay, granted, we kind of broke the structure of it, but who knows? Maybe it's, again, a deviation and it's a different version of that. And, it's still the same move. And we're still probably, who knows? We might end up going to a higher 30-year yield and actually sweep the previous high, the previous low on TLT. Or scenario number two, we're actually in this environment right here, where we actually just saw some kind of a deviation, and we're due for a big reversal in the coming weeks potentially. I'm open to both scenarios, honestly, and I would not be surprised at all if we actually do end up sweeping the previous low. We put in a massive double bottom, and then after that, we potentially go and have that huge bond rally that everybody's waiting for. Also, remember something else, that TLT is one of the most shorted assets you can find. Shorting long duration bonds is, as popular as apple pie as of 2025. That to me tells me that there is a lot of pessimism, especially if you look on Twitter, X. Nobody wants to own TLT and long duration bonds. That to me is just another indication that consensus is that we're going to have inflation and growth is going to be fine, as consensus was at the beginning of the year. We're straight back at square one. And, it'll take some patience, definitely. And TLT has definitely been a test of everybody's patience, I can imagine. I can definitely imagine. But, that's just how the markets work. Money has a funny way of finding its way, of going really from the impatient to the patient. The most important thing you need to learn, and I've definitely, had to learn this as well, is that the best thing you can do usually is nothing. Do pay attention. Do look at financial news, financial media, the data that comes out. But try not to do much. All right. If something that completely flips your thesis comes out, then do consider it. All right. I've given my thoughts on what that could be, and I've basically given two things that would make me reconsider my position in TLT, and really in the long end, and of the treasury market, and that is we get 0% tariffs immediately with everyone. That would be part one. Part two is we get some big stimulus package, immediate transfers to families, like COVID stimmy checks, right? Something like that. If we get something like that immediately, all bets are off at that point. Inflation is going to run amok because, again, yes, we're in a slowdown, but if you just give people money, the best, the moral of 2022 is that if you give people money, you better bet they're going to spend it. So those are really my two lines on the sand. And as long as I don't see that, I'm fine with waiting. And as usual, the reason how do you put yourself in a position where you're fine with waiting? Well, you don't overdo it. You don't go all in. Yeah, you leave some on the side, some on the sidelines, and if it goes down, you can always buy a little bit more. Why not? And on top of that, it's not like TLT you're buying into, some small cap business that is promising to make a product, and it's still developing, and it's a 3 market of a 500 million market cap or something like that. You're buying in treasuries, all right, and you're getting paid about 4%. Now, I can hear you screaming, yeah, but inflation is higher than what, and higher than that. Yeah, I know. But just consider that, right? Remember that you're being paid to wait. TLT and the long end of the curve is nothing more than an insurance policy that pays you to wait. That's the way I see it. So, again, you could argue, now that I just popped up in front of my eyes, you could argue that this is some kind of a double bottom, and I think that actually the weekly is the best way to look at this. it really comes out in a quite evident manner. You have this first move down, the first bottom, and then another bottom right here. Could this be the first double bottom? It could be. It could be. That would imply that we actually hold a parallel channel. Usually, I mean, whenever you see, things retrace like this, it's usually iffy. Again, I would be open to both scenarios, right? I would be open to this being, a turning point with PPI, being the catalyst. And I wouldn't be surprised if we do see a sweep of the previous low. Given the fact that we continue to have this stagflation, imminent inflation or reflation narrative take, the markets by the neck, really. So that's pretty much it for today. So again, what do we have? PPI coming soft. Initial jobless claims still at somewhat elevated levels, relatively speaking, of course. Continuing claims, same thing. Philly Fed was a little bit more optimistic. New York Empire State Manufacturing Index, a little bit more on the pessimistic side. Tomorrow we do have some consumer sentiment coming out, and I am sympathetic to the idea of this coming in a little bit, on the upside, simply because, again, we went from doomsday, we went from a total trade embargo against China to something manageable, which, isn't really that manageable because it's a big increase. It is a 30% tariff. Again, it is not good news, but again, what I say always is that, the US was saying we're going to chop a leg off, and then we say, we're not going to chop a leg off. It's great news. Yeah, it's great news that you didn't chop your leg off, but, you have a huge scar now because you were halfway through it. So, again, we go from 150 to 30%. Was that constructive? Absolutely. Could we see the consumer sentiment, match consensus or even a little bit further up? Potentially. And that really does it for this week. I'll be making a video hopefully tomorrow if I find the time about next week. And again, next week is quite important as we get our beloved PMI reports. So again, PPI, initial jobless claims, the surveys, some revisions. All right. Keep these in mind. And this was quite a long video, so I'll leave it at that. If you like this kind of content, consider leaving a like and subscribing to the channel, and I'll see you next time. Bye.